Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Today is another AMA episode. That is, Ask Me Anything. I love to answer your questions, and if you have a question you think is going to be of broad interest, send it in. I'll answer it live on the air. Send your questions to victor@victorjm.com. That's victor@victorjm.com. Jonathan from Arlington, Virginia asks, the Fed's signal of an imminent rate cut made me eager to consider how I can take advantage of the reduced rates through additional real estate purchases and maybe other business acquisitions. Then, the announcement that Deutsche Bank was going to lay off 18,000 employees left me stunned. The two seem eerily connected. I can't ignore the timing. Should one be bullish towards leveraging cheap debt and buying sensible assets with the real possibility of another financial crisis around the corner? Pursuing these acquisitions now can seize access to capital that likely won't be available in tighter times, but the risk of holding such highly leveraged assets is intimidating. Well, Jonathan, this is a great question. My reading of the situation is a little different. I'm not saying that Deutsche Bank is the only major bank that's struggling, but the company had ambitions to compete in the world of investment banking along with Goldman Sachs and JP Chase. They made substantial investments to grow those operations to compete with the Wall Street heavyweights. This is an area of the business that earns a lot of its money on the basis of corporate financings, bond issuance, brokering mergers and acquisitions, and IPOs. The trading desk for stocks, bonds, and commodities is also included in this business unit. The number of large corporate transactions have reduced significantly in recent years, even though the bond market remains highly active in terms of new offerings. This division turned a profit last year, but had lost money every other year since 2014. Most of the volume of the trading desks is increasingly being done by computer with no human intervention. You simply don't need as many people to execute the trades as you once did. While the volume of trades is up, it's a misleading statistic. The number of computer trades is way up, while those initiated by paying clients is down. The company has not disclosed where all of the 18,000 layoffs are going to occur, but they have said that the brokerage and investment banking business will be among the heaviest hit areas. The company employs 9,275 employees in North America, according to their public disclosures. Most of them are in the New York area, about 800 in Cary, North Carolina. About 150 software developers in the Cary, North Carolina office have already received their layoff notices. Investment banking is not at all like general business banking or personal banking. Investment banking relies upon large commissions. For example, in the good old days, if you did a corporate buyout and you, say, hired Goldman Sachs to help you find the money, the folks at Goldman would take a healthy commission, often as high as 6%. But now, the private equity firms that fund these deals, like Blackstone or the Carlyle Group, increasingly dictate the terms of these commissions. I've seen these negotiated down to 1.5% in some cases. And this, too, has had an impact on profits at the investment banks. The cuts are not limited to Deutsche Bank. Goldman Sachs, Citigroup, BMO, in fact, most of the European banks have announced substantial headcount cuts at their trading desks. Citigroup announced a cut of 10% of their equity trading desk in New York and large numbers at the bond trading desk. There's no question that the business of banking is changing across the board. The number of reasons for me to physically enter a bank branch continues to decline. I can now perform the majority of my transactions from an internet client or an app on my phone. I even now make most of my deposits using the camera on my cell phone, which is integrated with the bank app. The one thing that kept me going to the bank every month will eventually disappear entirely. Banks across the country are reducing headcount and closing lower volume branches. Banking simply doesn't need as many people as it once did. Technology is eliminating a lot of jobs, and a lot of the same banking can be done with fewer people than it was in the past. Will there be another financial crisis? Yes, absolutely. I believe there will be. I believe the next financial crisis will be driven by a problem in the sovereign debt arena. That means some of the banks with exposure to government debt will need to reduce their lending and borrowing. It will become much more difficult at some point in the future. Which government debt? Well, Greece still has a problem. So does Turkey, Italy, Venezuela, Argentina, Brazil, and of course the largest debtor of them all is the USA. These cuts are substantial, but I would not establish a linkage between the interest rates and these job cuts, nor would I sound the alarm bell for those looking to borrow funds based on these cuts. They're not connected in my mind. And this is the banking industry waking up to the reality that many aspects of the banking business have changed. Borrowing money is not just about interest rates. A number of lenders have become much more conservative in terms of underwriting rules, and they've tightened their lending criteria even if money's cheap. They, too, are worried about making investments late in the business cycle. I would advise you to continue to take advantage of the low interest rate environment and secure debt under the best terms for as long as you can. Thank you, Jonathan, for an awesome question. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.